All right, all right. Good afternoon, you magnificent melon heads, you. Happy Friday, everybody. It's my favorite time of the week, Friday afternoon live stream. Today, we're going to talk all about, is this bear market rally dead? We're starting to see indicators that, yes, it is dead, although we still have that peak inflation narrative that's out there. We're a couple of weeks away from our next CPI print. Our next CPI print, probably going to be another low one. So that could be something that could send markets higher. But this mounting pile of lousy economic data, it doesn't stop coming in. So we have a lot of reasons to send markets lower. And today just happens to be options expiration day. A lot of things could happen in the last few minutes of trading today. So we are going to see what happens throughout Power Hour. And right now we are going to say hello to Mish the Mod. How you doing today, Mish?
I'm doing great, man. How you doing?
I am
I like
doing awesome.
I like the
Awesome.
backdrop today.
You got a beautiful backdrop. I have to say, hashtag where's Mish? Where are you at today, buddy?
I am a little west of a place called Lusk, Wyoming, town of 5,000.
Lusk, Wyoming. What do they call the people of Lusk? Do they call them Luskians? Luskins?
Lusk.
Do they just call them the Lusks?
I like to call them Lusktonians.
Lusktonians. Okay, we're gonna go with Lusktonians since you're practically a local now. Well, please give my regards to the good people of Lusk, the Lucktonians. Lusktonians. All right, and looks like my man Matt the Cheeseburger is here today. How we doing today, Matt? And he's got DVN mooning right now. DVN being the ticker symbol for Devon Energy. Thank you very much, Matt, for the super chat. And I guess we're going to have to bring that chart up first. We typically take our trip through the indexes before we get into specific stocks. But since Matt has been so generous today, let's bring that one right up here. Ticker symbol DVN or Devon Energy. Full disclosure, I do not have any open positions in this company right now. We're up 1%. All right. All right, Cheese. I guess you have a very low threshold for Moon, but that aside, it's looking okay. Let's zoom out a little bit. Had a heck of a month here. What are we up? Started the month about 56. Now it's 68. So it's looking good. Oh, when you zoom out a little bit, though, there's that big plunge that just about all of the commodity stocks took towards the end of June here. Let's zoom this one out a little bit. I see what we're saying here. Just looking. Oh, wow. The MACD is looking nice. The RSI is looking nice. A series of higher highs, a series of higher lows. So I have to say, I'm liking the look of this chart right now. But again, I have no position in this company. Let me just real quick. We're doing this on the fly here. Let's throw for S's and G's a Fibonacci on here and just see where we're at. Where are you, Fibonacci? Let's see if we retrace from our high to our low. Where might we encounter a little bit of resistance on this one? Well, right about where we're at right now, this 61.8% line here. So you could argue we're sitting right about a resistance line if this was a Fibonacci retracement of this massive move that we saw down starting in the middle of June. So keep an eye on that level. If we get any big breakdown from here, it could mean moving lower. Now, Devon, this is an energy company. We're going to talk a lot about oil today, Matt. So stick around to later in the show because we're going to talk an awful lot about oil prices because I think we're very close to a big shift in the oil markets. And that should be very good news for Devon, which could take this one higher. All right. But again, full disclosure, I have no position in Devon Energy. And thank you very much, Cheeseburger, for the support of the channel, sir. I appreciate that. All right. So why don't we take a trip through the indexes? It is right now 3:20. We've got about 40 minutes of trading remaining in the day. And give me a second here. The S&P 500 is up down 55%. I'm stuttering today. The S&P is down 55 points or 1.3%, snapping a 4-week winning streak now. And the Dow is down 300 points or 0.89%. Again, this is options expiration Friday, so we'll see what do we have going into this last hour of closing. There's going to be a lot of trades settled in this last half hour or so. So we'll see what that does to stock prices. And then the NASDAQ leading the way lower today. The NASDAQ opened down and just kept heading down. And really, it just hasn't been able to stage any kind of a comeback all day. Now down 261 points or negative 2% on the day at 12,700. Let's see what we've got going on in commodities. We've got gold is down 11 bucks or 0.65%. Silver, woo, a beating in silver today, down 49 cents, almost 50 cents or 2.5%. Silver back below $19, even though the inventory levels at the COMEX, I mean, the COMEX is just bleeding metal right now. The amount of metal in that registered category just keeps going lower and lower day in and day out. And yet this price is still in the doldrums, hovering between $18 and $20. It's hard to tell where this one is going. Now, I've got some super, super bearish targets for silver out there. I almost gave Jim Lewis a heart attack when I said $11 one day, and that is all based on a resumption of this massive move downward we saw at the beginning of this year. If I'm right, if this is the end of the bear market, which it looks like we are either at or very near the end of this bear market rally, if I'm right and this is the end of that bear market rally, then we're heading back lower. It's probably going to drag metals down with it. We're going to keep an eye on that. You have to watch those COMEX inventory counts, though. Something fishy going on over there as usual. Looks like the other metals are a mixed bag. We've got platinum and palladium is lower. Copper's up just a little bit. Crude oil is pretty much flat for the day, right around $90. Interesting. We're going to talk a lot about oil today. Natural gas still grinding higher, now $9.27 per million BTUs. And looks like we got a little bit of life in the grain markets today. Wheat is up 3.25%. Corn is up 1.1%. And soybeans are pretty much flat, up 0.1% or $1.38. So a mixed bag today. Food and energy, a little bit more expensive, all the things you need, but stocks are down, your assets are down. So we all got a little bit poorer once again today. Isn't that
Hey,
just
Jake, if we go
lovely?
back to the Dow or the
Back to
NASDAQ,
the
when you had one up, yeah, the volume profile. If you look at the volume profile, there is no volume.
very little. Yep, very little. Let's zoom out on this a little bit. Let's look at a 6-month chart here. Yeah, definitely below average volume, especially for an options day.
Yep.
You usually should see a lot of options again. Last couple of minutes of trading today. We'll see what happens. I don't know. This is Power Hour on Options Friday, so a lot could happen here.
Yep.
All right, let's see what else we've got in the World Bonds Index. Looking at the U.S. Treasuries, we got the 1 month is up about a basis point and a half or 0.67%. The 2-year is up 2 basis points. The 10-year up 10 basis points. Big bump in the 10-year yield today. Looks like the yield curve is steepening today. Again, higher rates, typically not good for stocks. Now, I wanted to talk a little bit about the NASDAQ. We've been showing the NASDAQ chart a lot, and this is something I showed in my Patreon Zoom call on Wednesday when I have a Zoom call with a small group of guys, my Patreon supporters. Thank you, all you guys, if you're watching. We went over this chart on Wednesday because it really does look like this rally is just out of steam. All right, and I want to show you guys what I saw. Like this chart, if you've been watching my live streams for the last few weeks, this is nothing new. This is showing it's about 8 months, or really a 1-year chart going back. And you see, I've been drawing a Fibonacci retracement of this big move down. And that combined with this descending wedge pattern, they both lined up with a target of around 14,000 in the NASDAQ. And I had mentioned over the last week or two that we had some short-term resistance we had to get through. So I'm going to get rid of this Fibonacci sequence right now just to make it a little bit easier to see. And I want to put the 200-day moving average on here again. Let's put that one up there. Chart might get a little messy today. So you can see as we headed up and we got near that 50% line in the Fibonacci retracement and we were approaching the 200-day moving average, we ran out of steam. Now, what's got me the most worried about this chart is down here in the momentum indicators, the RSI and the MACD, because I want to show you a little bit. Let's make the RSI a little bit bigger so you can kind of see it here. Look at this, what kind of looks like a double top in the relative strength index. And this is a measure of the momentum of a move. All right. And if you look at the highs that we made roughly on August 4th and then on August 15th, those were the highs in the RSI. We failed to make a higher high in relative strength. So there was no more momentum to the move, and yet the price continued to move higher. And that's a very strong sign that your buyers are getting tired, that this move is running out of steam, that the chart is about to roll over and turn south. And the other thing is the MACD, that's the moving average convergence divergence. That's down here, this chart right here. You see the MACD has already started to roll over, and we are right on the edge of a death cross in the MACD where the MACD crosses below the signal line. That's a very bearish indicator. All right, so we've got a double top in the RSI. The price has continued to move up, but we have not made a new high in momentum, and we've got this MACD here starting to roll over and making a death cross. All right, this tells me the NASDAQ is out of gas and that we could be heading lower. Now, I always want to present both sides of the trade or both sides of the story. The flip side here is this narrative of peaking inflation, this narrative of the pivot from the Fed. All right, that's still out there. This whole rally has basically been built on the backs of peak inflation, and the Fed pivot is right around the corner. Personally, I don't think the Fed pivot is right around the corner. Right? If we take Joe Biden at his word that his goal is to reduce the tightness in the labor market, well, that 528,000 jobs number we got last week or 2 weeks ago, I can't even remember when it was, that threw out any possibility of the Fed's pivot. All right. So I don't particularly buy into the theory that the Fed pivot is right around the corner. I do think eventually they're going to have to pivot or the government will become insolvent, but that's not yet. They're going to cause a lot more pain yet. They've told us they're going to do that. And the other thing that's out there is we have another CPI reading. The next CPI print, I believe, is September 13th. And it's probably going to be another lower one. We might even get a negative month over month inflation number on the CPI print. We might. All right. So that's going to be the market will interpret that as good news. That's going to be bullish for stocks, but that's 3 weeks away, more than 3 weeks away. So I'm not sure that CPI print is going to get here in time to save this bear market rally. We could be a lot lower by the time that happens. So it really looks to me like this bear market rally is over. That's what it looks like. I'm not saying it definitely is. I'm saying we are at least near a short-term top. And I have to send a shout out once again to my friend Cheeseburger. He said, did Joe mistime the release of the SPR? Is oil going to start spiking up just in time for the midterms? Yeah, I see Mish over there is nodding his head. He's partially covered by your super chat, Matt. But yeah, right now, the initial release of the SPR was supposed to end at the end of September. That was the one that he announced in May. And then we had another announcement. I think it was in early August or late July when he came out and he said, we're going to announce another 20 million barrels of oil from the SPR, and it was going to be released at the same rate. So another 20 days of SPR releases. And that took him out to like the end of October. So right now, it looks like the SPR releases are scheduled to end about 18 to 20 days before the midterm. So I would not be surprised to see another 20 million barrels of oil dumped from the Strategic Petroleum Reserve. And by the way, Matt, thank you very much for the super chat and the support of the channel. I really appreciate that, sir.
Hey,
And
Jack,
speaking of oil, what do you got, Mish?
I was going to say, I think it's important to mention, I don't know if we're going to talk about this later, about the mismatch that's happening because of the release.
The mismatch in
what is being reported versus what actually is out there in the
as far as the inventory counts go.
The inventory counts.
Yeah, let's talk about that one.
Yeah.
Go ahead.
So because of the SPR release, we keep getting these big positive numbers and the negative numbers, right? The negative numbers are a lot closer to what's going on. The positive number days and weeks are because those are release days, so it's skewing the market.
I'm looking for those data points. When do those data points come out? You're talking about the EIA oil inventories, right?
Yeah. Yes,
here we go.
Yep.
So we're looking right now at the chart that you're talking about. So this is all over the place, right? Big up days, big down days. What am I seeing here?
Those are actually weeklies.
Weeklies, right?
So what you're seeing is all the blues or the release weeks.
So when we'll get a 5 million barrels released from the SPR this week, or 7 million, right?
Yeah.
So once it's released from the SPR and it goes into the market, that's when it hits the inventory numbers. Is that
Yes.
correct? Okay.
Yes. So what you're seeing then is a build in inventory that is starts being divergent from what's actually in there because we're showing that we're releasing it, but it's not really going to our inventory, it's getting sold.
So it's like I've been saying for a while now, it's fake. The supply demand dynamics in the oil market are basically fake right now. They're being artificially inflated by the federal government.
Yes, and that's what this curve is showing. And I know Bruce here is about to start weed eating, so I'm going to mute.
Yep, that's fine. We're gonna head over to the oil chart, and thanks again, Cheeseburger, for the support of the channel. I really appreciate that, sir. All right, let's look at the oil chart because that's another one that I really wanted to talk about today. Because I'm seeing a lot of the same indicators, at least in reverse, but a lot of the same things I saw on the NASDAQ chart. All right, this is crude oil futures going all the way back to last fall. All right, you can see here's the spike. This was the Russian invasion of Ukraine, and then we came back down, and then right about here, the end of June, we start dumping from the Strategic Petroleum Reserve, and prices start heading lower. Now, there's a couple of lines I want to draw on this chart. First of all, let's connect some of these recent highs here. And I want to connect these guys. That line's a little low. I drew this. This is another one that I drew on my Patreon live stream this week. Thanks again to my Patreon supporters for everything you guys do to support the channel. All right, so here's this line of resistance that we hit a couple of times on the way down during this price correction. Maybe I could even draw it a little bit there, like that. Now, if you look down here more recently, we had a false breakout from that downtrend right about here. You see that there? We broke out above this line. We just barely kissed the 200-day moving average, and we broke down. We failed there. The next day, we came back up. We tried again at the 200-day moving average, and we failed, and we came back down under this line. All right. That is a first failed breakout attempt of this downward channel in oil prices. All right. So that doesn't mean that the bottom is in, but that means that the market's looking for a bottom, that we're at least near a bottom. All right. And then you'll notice the last couple of days here, we broke above this line again. All right. So we are above this line. I'm still not calling a breakout yet, though. And I want to show you some other things here, namely in the RSI. Let me make the RSI a little bigger so you can see it. But check this line out here. All along the bottom. How many times have we touched this floor in the relative strength index? All right. The selling has come in. Oil prices have been beat down, 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 all the way from the 120s down into the low 80s, or the mid 80s at least. And you can see we first hit this low in relative strength all the way back up when oil was still over $100. And we bounced off that line once, twice, 3 times, 4 times, 5 times most recently this week. Every time we failed to put in a new low in the momentum, in the relative strength index, and yet the price continues to make lower lows. Again, this is a sign that the sellers are exhausted, that this move down is running out of steam. Pretty much the opposite that we saw on the NASDAQ, where the buyers are getting tired. In oil, the sellers are getting exhausted. And just like in the NASDAQ, we've got the MACD starting to roll over. It's starting to push and turn back upward. So it looks like oil is really trying to put in a bottom here. All right. Now, I have to caution you on calling a bottom in oil yet, because there's a couple of very bullish stories out there for oil. Number one is this collapse in China, right? A deep recession or even a depression in China would be very bearish for oil prices. China burns through a lot of oil, the world's second biggest economy, right? So a major slowdown in economic activity in China would send oil prices lower. We've also got this story out there. The Iran nuclear deal is tantalizingly close. Tantalizing. That's an interesting word that they would use. tantalizing, almost like the Associated Press is just watering at the mouth. Ooh, a foreign policy win for Joe Biden. It's tantalizing. They just can't contain their enthusiasm. But the U.S. faces new hurdles. Now, what they're basically saying here, last week's attack on author Salman Rushdie and the indictment of an Iranian national in a plot to kill a former national security advisor, John Bolton, has given the Biden administration new headaches as it attempts to negotiate a return to the 2015 nuclear deal. So Iran is getting a little froggy right as this deal was about to be signed. And something else that I have been watching this week is Iran is now kind of increasing the price, if you will. Iran is saying they want some kind of guarantees of compensation if the U.S. decides they're going to pull out of the deal again in a few years, like, say, the Republicans take back the White House and a new president decides, I want out of this deal again. Iran wants some kind of automatic payment to be triggered to them if that happens, or some kind of guarantee. The U.S. is saying, yeah, no, we're not going to give you that. Now, this was never on the table. Iran made this demand after this final draft of the European deal was put out there. Iran also added at the last minute that they want the IRGC, that's the Iranian Revolutionary Guard Corps, the elite arm of the military in Iran, that they want the IRGC pulled off of the terrorist supporting watch list, or the terrorist list. And again, the US said, no, that was never on the table. We're not going to give you that. So I see Iran is, you know, several things acting up, a plot to kill a former UN ambassador, this attempt to stab and murder an author here in the US, making fresh demands right before the deal is signed. It seems like the United States wants this deal a lot more than Iran does, and that Iran is just raising the price at the last minute. And honestly, if you're Joe Biden, you're probably going to sign anything the Iranians put in front of you, right? Politically, he needs a foreign policy win, or the appearance of a foreign policy win, because doesn't really have many of those. He needs oil prices lower. He needs gases prices lower because inflation is killing him in the polls. Well, this would bring at least some new oil supply onto the market. So if I had to bet, if I absolutely had to put money on it, I'd say that this deal is going to happen. All right. That's if I had to bet. I don't have to bet, and I don't have any bets because I don't have any open positions in oil right now. But if this deal happens, I think that will mark the bottom in oil prices very soon after this deal happens. It'll probably be initially bearish for oil prices. We might see oil shed a few bucks, but I think it's going to find a bottom real fast because those midterms are coming up. The SPR is draining down. They're not going to keep releasing that oil much longer. On top of that, we've got the prospect of Europe burning oil for electricity this winter. We're already starting to see stories about that. They're starting to fire up some of these old oil burners because they can't get enough natural gas. So burning more oil for electricity, although archaic, that would be bullish for oil demand. That's more demand for oil coming on the market. So there's a lot of variables in play right now in oil markets. But just looking at the technicals tell me we are very close to a bottom, if not at that bottom. But again, I don't have any open positions in oil right now at the moment. And I see we have got Mr. AK. Hello, AK. Thank you very much for the super chat. He says, remember the 26th of September, then you'll see the real bear market we're in. I'm still buying shorts. September 26th. I wonder why you say September 26th. Is that when the SPR is supposed to be, when the SPR reserve ends? What happens on the 26th? I'm wondering. That's a new one here. But thank you very much, AK. I appreciate the support of the channel. Let us know in the comments what happens on September 26th. I know September 13th, that's the next CPI print. I feel like I should know this. That's interesting. But thank you, AK. I appreciate that. I appreciate the super chat very much and the support of the channel, sir. And we are going to move on here. It is now 3:40. We got 20 minutes left of trading. Let's see what's going on in markets, if anything is moving just yet. I'm looking at the S&P right now. Looks like no big movements into the close just yet. S&P is still down 55 points, or 1.29%. The Dow, I moved the Dow chart. Let's go back to a one-day. The Dow looks like it's selling off a little bit into the close, down 290, or 0.85%. and the Nasdaq is down 255 or 1.97% up off the lows of the day, still down pretty significantly. So no big moves in the last few minutes, at least not yet. We'll see what we get in the last couple minutes of trading here. Another story I wanted to talk about, folks. This chart, you've seen this a lot on my channel here. This is the ICE Dutch TTF natural gas futures. This is the benchmark natural gas price for the European markets. And this does not bode well for Europeans this winter. Folks, my European followers out there, my hat's off to you guys. Hang in there. I don't know what is on God's green earth the leadership on that continent is thinking. But right now, $257. This is euros per megawatt hour equivalent is the units on this one. This is basically, this is trading at about 7 or 8x what natural gas prices in the United States are right now. And unfortunately, they are hopelessly, hopelessly addicted to natural gas in Europe right now. And this chart just keeps marching up. It just keeps heading higher. And, look, let's look at a 1 year. Well, we're already looking at a 1 year chart. Let me zoom out a little bit more. Looking at 5 years. I mean, look at this. This is what the leadership in Europe has created right now. I mean, the low prices that you guys enjoyed throughout the last decade down here, 21, 22, $23, 10, 13, 15, and now look at us, 257 euros per megawatt hour equivalent. So you just cannot run a modern economy on energy prices that much. Energy is an input to everything. We're already starting to see stories about metal smelters in Europe shutting down again, fertilizer plants in Europe shutting down again. And I really think when it gets cold in Europe and when we stop dumping the Strategic Petroleum Reserve, we're basically looking at a rinse repeat of last fall and last winter where energy prices just march higher, dragging all commodities with it, especially food prices. Remember, food is pretty much a derivative of energy. You need fertilizer, you need natural gas, you need electricity to make fertilizer, you need fertilizer to grow crops, you need diesel to power your tractors, and you need diesel to move the trucks and the barges to move the grains around. So it really looks like all of those commodity inflation trades are going to come back with a vengeance this fall. It's all going to happen right about the time it gets cold in Europe and we stop dumping the SPR here in the US. But, hey, it gets them just enough time to get past the midterms without those inflation numbers killing you in the polls, right? Who cares what happens to people afterwards as long as you incumbents manage to stay in office. So, again, I feel for you, Europe. Hang in there, guys. It's going to be a rough winter, but we never know. Maybe Mother Nature will bail you out. Maybe we'll get another warm winter and you guys won't have to worry about that one. All righty. Let's see what we got here. The 10-year Treasury yield. Here's another one that I brought up. This head and shoulders pattern, folks, it looks like it's dead. I don't know what happened here. We peaked around July 14th. That was right before the 75 basis point rate hike. And it looks like we bottomed at the end of July here, just after that week where we got the rate hike and the negative GDP and all the big tech earnings. And yields have just moved straight up since then. So I almost need to retire this head and shoulders pattern here because it looks like interest rates are intent on resuming this upward march. And again, if this bear market rally is really over, if the NASDAQ is rolling over, if it's heading lower, well, higher yields, very bad for the NASDAQ. So this may be a resumption of this upward movement, this pause in the rate cycle. Yields heading higher. And I saw this one today. This is an interesting story. Let me preface this by saying home prices have still not moved. If you look at the actual sale prices of houses, what excuse me, what they're actually closing for, sale prices have not budged. Okay, the prices, they've stopped going up as fast, but they haven't come down yet. We're seeing list prices are starting to come down a little bit, right? People put their house on the market at a really high price. It doesn't sell, so they lower their asking price. But the actual sale prices haven't come down yet. And but we're seeing a lot of other weakness in the housing market. And check this one out in Bloomberg. U.S. mortgage lenders are starting to go broke. After the crisis, banks account for less of the mortgage business. Independent mortgage lenders are seeing their credit lines cut. So after the global financial crisis, a lot of the big banks pulled back their mortgage businesses. And we saw a lot of new, they're not banks, they're just mortgage sellers, kind of came into the market acting like banks to fill in that market share. And reading from this article, the US mortgage industry is seeing its first lenders go out of business after a sudden spike in lending rates, and the wave of failures that's coming could be the worst since the housing bubble burst about 15 years ago. There's no systemic meltdown coming this time around because there hasn't been the same level of lending excess, and because many of the biggest banks pulled back from mortgages after the financial crisis. But market watchers nonetheless expect a string of bankruptcies broad enough to trigger a spike in layoffs in an industry that employs hundreds of thousands of workers, and potentially an increase in some lending rates. Now, what they mention here, an, an industry that employs hundreds of thousands of workers and layoffs, I think the missing ingredient from a housing crash is still layoffs. Right now, the job market, at risk of parroting some of the most ridiculous things I've ever heard in the mainstream financial press, the jobs market remains somewhat strong. All right. You have a lot of people are underemployed doing part-time work for financial reasons, but we still have most people working. And you don't get a massive crash in housing prices without a wave of foreclosures. You don't get a wave of foreclosures without a massive layoffs. And we don't have that massive layoffs yet. All right. So that's why I don't think we're sitting on the edge of an apocalyptic housing crash. Home prices may not be going up anymore, but that doesn't mean they're coming right down. Until we get layoffs, until we get massive job losses, home prices aren't going to budge. They're going to stay where they are. And I want to talk a little bit in here about one particular case here about First Guarantee. All right. That's the name of this mortgage company. First Guarantee, a company that, according to court papers, is majority owned by fixed income giant Pacific Investment and Management, filed for bankruptcy, saying it failed after it made loans earlier this year that dropped in value. Remember, a loan is kind of like a bond, right? It's a promise of future payments. Well, when interest rates go up, the principal goes down. Remember, the two are inversely correlated. So those future payments are worth less now, the bond goes down. So this company that makes mortgages, they their mortgages that they had sold dropped in value, but the mortgages company, it was holding on to those loans until it had enough of them to bundle up into bonds and to sell to investors. And it had been temporarily funding them with lines of credit. So what they're saying here is this company, First Guarantee, they would borrow money from their credit lines, and they'd use that borrowed money to issue mortgages. All right. So now they've got the liability of the credit line and they've got the asset of the mortgage. So there should be no real net difference. They're collecting some fees, making a little bit of profit. The problem is when interest rates went up, those loans that they made went down. So now their assets are worth less. They still have the lines of credit, the liability over there. Probably their line of credit, the interest rate might have even gone up. So now they're underwater. Now they're losing money. And because they haven't yet made enough of these loans to package them up into a bond and sell them to investors, it's still sitting on their books. And then the problem was when that credit starts to get cut off, when the banks come in and say, First Guarantee, now you're too risky. We're not going to lend you any more money to make any more loans. Now the company is insolvent and now they go bankrupt. So these are like miniature versions of what happened to the banks in 2008. They're happening on a much, much smaller scale with these smaller companies that made risky loans. All right. So this is not a replay of the GFC, but you do have these small mortgage lenders. Some of them are starting to go bankrupt because they got caught playing hot potato with all these loans on their books. Interest rates went up, their credit line got cut off, and now they're screwed. So that one is out there. Again, I don't see a major crash in home prices, at least not yet.
So you'd say the music is slowing. The music has not stopped.
Yes, Zachary Quinto, I would. That is a line directly out of Margin Call. The music is slowing indeed. And the situation with that First Guarantee that I was just talking about was actually almost verbatim the situation that that character painted at the table, when they were having that big board meeting in the middle of the night in the movie Margin Call, right? They had the loans on their books. It takes them time to package them up into bonds and then to sell them to investors. So until that sale to investors is made and you collect that money, you're holding the hot potato. You've got the liabilities. And it went down in value and they were stuck holding the bag. But you know what? They were about to sell that bag to somebody's pension fund, so I do not weep for first guarantee. No, I do not.
Looks like
Let's see.
2 super chats.
Yeah, we got a couple. We have got oh, we got AK calling me out. All right, AK. Why do you use Yahoo Finance and not TradingView? That is a legitimate question. I've been using Yahoo Finance for well over 10 years, and I'm just more comfortable with it. I have tooled around in TradingView and I've messed around with it, and I am learning it. I'm not confident enough in TradingView yet to bring it on the air because it'll be me sitting here trying to remember how to do it. And oh wait, do I click here? No, I click somewhere else. And you guys don't want to sit there and watch me fumble around clicking on the wrong tool or the wrong drawing. It makes for a very slow, boring show. So as long as I'm more comfortable in Yahoo Finance when I'm on the air, I'm going to use Yahoo Finance. But I am developing TradingView. It's a work in progress. It's going to take me a while. But they called me out. I was wondering. I've had people suggest I use TradingView. Nobody's ever called me out in a super chat for that one. Touche, AK. Thank you very much, sir, again for the support of the channel. Did we ever get an answer on September 23rd or 26th? Was it the 26th he was saying was the big day?
Somebody was saying that's the Fed announcement date.
Oh, that's the next FOMC. Oh, okay. Yeah, that could be FOMC meetings, they're always big days, right? A lot always happens when the FOMC gets involved. So, yeah. Geez, I got to remember to turn that thing off. All right. Thank you very much, AK. I appreciate the support of the channel, sir. And who's the next one here? I saw somebody was on here. There he is. Darren Jones. Thank you, Darren Jones, for the support of the channel. He says, do you happen to know the next ex-dividend date for SPY? SPY being the S&P 500 Spider ETF. I don't know it off the top of my head, but why don't we look it up? Let's see. What is the next dividend date for SPY? Thank you for the super chat. I believe they show that right here on the first page. No, they don't show X dividend on here. Son of a gun. No, they don't. Sorry, but I don't have that information. Couldn't
There
tell
should be
you.
a dividend
What's that?
tab. There should be a dividend tab.
There is no dividend tab. Historical data options. Yeah, the ETF charts are different. Normally, you can find it on the statistics tab for a stock, but they don't show it on the options. So, gonna have to IO you that on that one. Who can tell me the ex dividend date for SPY? We owe Darren an answer. Who can give me an ex divvy date for SPY? But I would caution trading around the ex dividend date. I wouldn't. Some people do it. Some people swear by it. I don't think trading around the ex dividend date really does anything because on the ex dividend date, the share price drops by the dividend amount. So you don't really make any money trading around, timing your trades with the dividends. Pay attention to dividends if you're holding long term. And if you're going short something, avoid anything that pays a dividend. That's all I could warn you because if you're going to go short, you're on the hook for that divvy. But thank you very much, Darren. And I apologize. I don't have that date for you at the moment, but we'll see if somebody comes through for us in the chat on the ex dividend date for SPY. And there's my man, Mike. Hello, Mike from Robin RC Models. He says, it's over. We're going straight down. Wait until the big guys are back from the Hamptons and look at the paperwork. De-risk now. So Mike is saying the big money, they're just all on vacations, living the sweet life in the Hamptons. And as soon as the vacation is over and they get back in the office, which why would you ever go back in the office in the era of work from home? Well, he's saying as soon as they get back, they are going to resume their dumping. Solid theory. What do they say? Sell in May and go away. That's the old adage. And then look out when the kids go back to school and the business starts up again. Very plausible scenario, Mike. I won't dare disagree with you on that one. But thank you very much, Mike. I appreciate the support of the channel as always, sir. And let's see. We are going to hide that one.
Your answer on the ex div date?
Oh, we got it.
It's not Well, it's not out yet. There's a couple people that put it in there. It should be around September 17th because that's about 3 months after the last ex-div date.
All right. So I'm seeing September 17th or 18th. Thank you guys. I appreciate you chasing that data down for me. See, I have the best viewers. Absolutely the best. These guys, quick draw with that information. That's awesome. All right.
Sage, saying hi to Sage.
Hey, Sage. We've got Sage's in the chat, and we got Sage coming up in just a couple of minutes. He has got an awesome little economic traffic report for us later. That will be coming around probably about 4:05 after the markets close. We are going to be bringing Sage on the air. He's got something juicy for us today. I was really shocked when he showed me this, and this is going to be good. But right now, we are on China. As I saw this one today, Chinese builders rally on plans for state guaranteed bond deals. Now, this article is a couple days old. This came out on the 15th, so it's 4 days old. Select firms to have new onshore debt backed by the state. People and investors say rebound in home sales is key to any sustained rally. Don't bank on a rebound in home sales in China anytime soon. Trust me on that one. Let me just read a little bit of what's going on here, and then I'll give you my take here. China's embattled developers surged in stock and bond markets on Tuesday on news that authorities are planning to help some raise fresh financing, adding to signs of official support for an industry grappling with a debt crisis and slumping home sales. Notes from Country Garden Holdings, Seafy Holdings, and Longfor Group soared at least 11 cents on the dollar Tuesday, according to Bloomberg compiled prices set for the biggest gain since March. Their shares surged more than 9% in Hong Kong, and Bloomberg intelligence gauge of the sector gained 2.4%, the most in 3 weeks. Chinese authorities have told several property developers that state-owned credit support provider China Bond Insurance Company will give full guarantees for some of their upcoming onshore bond offerings, according to people familiar with the matter. The first batch of private developers to be included in the plan include Longfor, Czen, Seafy, Country Garden, and Gemdale, I don't know which one that is. The people said, asking not to be identified. So here's the deal with this story. These are all developers that have not yet defaulted on any of their bonds. All right. These are the good ones, if there is such a thing as a good Chinese developer right now. Right. Country Garden, they're the biggest one in China. Now, their share price has been beaten down and their existing bonds have been beaten down. So it's gotten much more expensive for all these companies to borrow money. And these companies need to borrow money because the way real estate is done in China, it's basically a Ponzi scheme. You borrow money to build homes, you sell homes that are not even built yet to investors, and then you have to build the homes and deliver on them. Well, what they're doing is they're taking the money and then they're just going and starting new projects, doing more pre-sales, using the pre-sale funds from their newest project to complete construction on the previous project. It's a Ponzi scheme. That's how a Ponzi scheme works, where new investors pay off old ones. So what the Chinese are trying to do here is they are trying to prevent any more defaults in the property sector. This is about, Mish and I were talking about this the other day, and we said, is this a Band-Aid? And Mish, you came up with it. This is actually this is a tourniquet. It was a great analogy, right? They've got this gushing wound and they're hemorrhaging cash, and they're trying to put a tourniquet on it before they lose any more blood. This is not going to do anything to save Evergrande. Not going to do anything to save Fantasia. This isn't going to stop the mortgage boycott. This is about not making it worse by not having these other developers, the ones that haven't failed yet, not adding them to the list. This is also a subtle loosening of the policy. The three red lines was all about no more debt for the developers. So to see Beijing acting as co-signer on a loan for these developers, right, that's kind of a bailout. So, by the way, on the subject of China's real estate, I just wrapped up a great interview today with the last bear standing. He's got a Twitter feed and a Substack that is outstanding. It was really good stuff. I'm going to release that interview in 3 separate videos over the next couple of days. The first part will come out today, probably around 7 p.m. Eastern time. I'm going to release that one. Last Bear Standing is one of my favorite feeds on FinTwit. I read literally everything he puts out because his work is outstanding. So keep an eye out for that in the next few hours. And I got real quick, I want to say hi to Cheeseburger again. Thank you. Regarding your work habits, do you employ the Homer Simpson model with the bird hitting the Y button on your keyboard while you're off making YouTube videos? Can you see the bird with the Y button behind me? One day we'll talk more about my work habits. Today is not that day, Cheeseburger. But don't worry. Your radiological future is safe. You will not be breathing any radionuclides on my behalf anytime soon. So thank you very much, Matt, again for the super chat and for breaking my balls. But I appreciate that very much. I see Dad is in the chat. Hi, Dad. I forgot to say hi, Dad. Hi, Mom. I love you guys.
He's actually talking smack.
Oh, Dad's talking smack. Well, gambles are funny like that. He's just jealous I'm the prettiest of the gambles. But all right, let's take one last trip through the indexes here, and then we're going to bring Mr. Sage on. I have got the S&P 500 closed right. Let me refresh this window and make sure this is updating because we were at 55. Yeah, that's the deal. S&P 500 closed down 55 or 1.29% to 4228. Is that a negative close for the week? It is. So we have broken that 4-week winning streak. I wonder if that is a sign that this bear market rally is over. The Dow closed down 292 or 0.86% at 33,706, and that is just barely positive for the week.
It's close.
It's pretty much flat, just barely. So the Dow's faring better. The NASDAQ ended up closing down 260, 2.01% at 12,705, and that is deeply negative for the week. We started the week right around 13,000.
Because we were trying to decide if it was going to hit 13.5 or not.
Yep. We were talking about that 50% line, which was right around there earlier this week, but not breaking it this week. Again, does that mean this bear market rally is over? All the technicals are saying this rally is almost out of steam. Not necessarily calling a top here. I'm just saying the technicals don't look good for the indexes right now, not particularly the NASDAQ. All right, guys, it is now 4:02, and something we started doing last week. I called it the economic traffic report, and I've got my man Sage Eric from Sage News is here. How we doing today, Sage?
Hey, how's it going? I received the uniform that you mailed me.
I was going to say you're looking good, my friend.
Well, I put it on just so I could be on the show. How's it going, buddy?
It is going really good, really good. So look, all the radio shows, right? Your morning, your afternoon talk radio, when you're on your drive home, they all have the traffic report, right? Some guy in a helicopter talking about it's backed up on the bridge or whatever. So I kind of figured let's do something like that with Sage because you're so in touch with logistics and the movement of stuff around the world.
Yeah.
That we could do like an economic traffic report. What is the world of shipping traffic telling us this week? And you got something good for us this week, Sage. I remember we talked about this one earlier. Yeah. So take it away.
Going on now here from the top of the helicopter. Okay, so basically, look what I got. So what we're going to do is we're going to talk everybody's favorite topic, which is cans and containers and kind of feeling that out. So kind of what you're looking at right now is containers, container ships, and things like that. Our East Coast is definitely busy. But what I kind of want to show you is a couple of things. So the first thing, this came out of G-Captain, was the Baltic Dry Index falls to the lowest level since 2020. Now, remember, Mr. B, the head of the thing, says, we're not in a recession, which is kind of amazing. But it doesn't kind of look that way, and I kind of want to go over this. Now, this just came out, basically. So we're looking at some fresh stuff. And what this is this is Freightos.com, and anybody can sign up if they wanted to, and at least for a free account, but you can also pay for an account. But this is the free account. So what you're kind of looking at right now is Global Container Index, and the Global Container Index, this is shipping all over, and it's an index all over the world. Basically, is definitely down. I mean, it's basically in October 21 you were up here, February 22 it started to taper, and then boom, she just started to come down. But a big indicator for us is going to be what we're shipping from. What China is coming to this one is going to our West Coast. So container pricing has basically come down to a lot. At one point, a container went for $32,000 from China to the United States because that's how high demand was. It was up there at $28,000 and $25,000 for a long period of time, but it has fallen dramatically now down to about $5,700. Now, normal can, before we knew we'd ship something from China to the West Coast would be about $4,000, $5,000. So we're kind of dropped immensely in regards to demand. One of the main charts I definitely wanted to show was this one, and I talk about this a lot on my show. Is going to be this one here. It's the bullwhip effect, and what you have is it's like whipping a bullwhip. You get the ripples, basically the ups and downs, the peaks and valleys. And this one right here kind of tells us that you can see at one point this blue line is this year, and this green line was 2021. So you can definitely see the difference right here in pricing, that we are dramatically dropping in the amount of freight that is moving through cans and containers, basically everywhere. I mean, everywhere the price is coming back down, which means people are not buying things, they're not ordering things. There's no demand for these cans, for these containers to be ordered from China. You've covered articles and you've done stories that stores are basically saying, look, I'm canceling my orders right now. I don't have enough room for them. I don't have enough storage. So the basic gist of it is this line's going to continue to go down, I believe. And as this goes down, logistically, we see recessions and bad times before anybody else does, just because of the amount of freight that's moving. I've got about a 120-day head start knowing what's going to happen. And my 120-day head start is canceling orders. So stuff that was supposed to be coming is not coming. And we've got that 120-day gap, usually 90 to 120-day for an order to be placed from China for it to basically be in your store. And it's dropped dramatically.
Now, Sage, how much of this would you chalk up to fuel prices, and how much would you chalk up to there's just less demand to move things?
It's less demand. The fuel prices, although if you need the stuff and you can sell the stuff, fuel prices, you're going to pay for that ship, right? That's in the price of the container. People were still ordering when containers, because people were buying, people were still ordering when containers were 10,000, 11,000, 12,000, 20,000, right? So they were still ordering when those containers were that price. Basically, we've gotten to the point that stores are full, warehouses are full, and the big retailers are basically saying, look, I don't have any room to put this stuff. Don't send it. Don't stop my order. And that's kind of what we're seeing. If people are paying for things, fuel doesn't really matter. It's supply and demand. And right now people are pulling back and getting the stuff they need, not the stuff they want.
And I tell you, folks, this is deep recession right here is what this is telling me, because business investment is one of the main categories. You've got consumption, business investment, government spending, and then net imports and exports. Those are the four inputs to GDP, those four things. And under the investment category is inventory, all right? Orders of new inventory, that goes under the I. And what this chart is telling me, this big drop down in the rate of shipping, combine that with the story that I did a few days ago about Walmart and Target canceling their orders. Stores aren't ordering anything.
Correct.
Look, this is the time of year. I mean, is this not when they would be ordering like crazy for the Christmas shopping season?
Yeah, so you have normally you have dips in like 4th of July and things like that, holidays. But after 4th of July, you have a little break. But right now, this August area, mid-August, is when you'd be putting in your orders for Christmas. You'd be putting in your orders for schools. You'd be putting in a lot of those orders. We get that stuff from China. If you think all of the school supplies, all of the Christmas type goods, all of the sneaker, all of the stuff that you would normally get, orders would be put in now for them to start to hit September, October, December, and then it kicks down again, and then it starts back up somewhere in March, and we're canceling the orders. And what this does is, logistics is algorithms. You really want to be consistent, right? When you break those algorithms, it's very, very, very difficult to break this bullwhip effect, because what's going to happen is all this is going to go down. And then, of course, the government says, okay, we'll save you. Here's a bunch of money, usually, right? And then everything goes back up again, and we have another bullwhip effect. And I really believe that, in my opinion, the feds are going to come out and do another 5 point or 0.75, because they're seriously trying to break this bullwhip effect. Because if it spikes up again, the inflation is going to be crushing. It's going because trucks drivers, this line going down causes truck drivers to get out of trucking. It causes them, a lot of transportation people to get out of the industry. So when it kicks off, we don't have enough trucks, which means we have to pay higher prices for shipping. And then we also have a possibility of a railroad situation in about 30 to 60 days. And that's something else I'll be covering next week.
Wow.
I'm not banned.
Assuming you don't get put back in YouTube jail. Sage and I were practically cellmates in YouTube shadow ban jail over the last couple of weeks. I finally just got out of the doldrums. I said mean things about the FEW backwards, if you will. Every time I mention a certain worldwide financial group, I go 30 days without any growth in my channel. All right. So unfortunately, that's a very real issue, folks. And I guess that's all I have to say about that one. But Sage, I remember we talked about this like a day or two ago.
Yeah.
And I couldn't believe the gap between that green line and the blue line, right? Remember last year we were talking about the backlog at U.S. ports and how you just couldn't get anything. Everybody was spending their stimmies, just buying crap and bringing it over by the boatload. The opposite now.
Right. And this is
the opposite.
100 ships in here, and they're down to about 14 in front down here. And and of course the ports compete. It's a money-making thing, right? They're not we forget that they're actually looking for business. So they basically came out and said, "Hey, bring your ships here. We're ready. Bring them here." But a lot of manufacturers, are basically saying, "Look, we're not shipping them to you." And they started sending him over to the East Coast. So the East Coast traffic has bumped up a lot compared to the West Coast. So it's a, like I said, and a lot of that picture in these is global, right? You're looking at this global aspect, but we're a big contributor to this global aspect because we buy a lot.
Absolutely.
And we're not buying a lot because of our inflation.
Hey Sage, are we ever going to get you out of town and come see one of us at the Silver Symposium, man? Or
I don't think I can even get out of YouTube jail. I'm still losing subscribers, so I'm at a point now where he stole my shovel and I figured out he was basically digging behind the toilet. With my little spoon I had for eating, I had to eat with my hands for half a month. So he was able to get out, but I'm still in it. No, I don't. The issue with me is I can't go anywhere. My wife has some stuff like agoraphobia and things like that, so I can't leave. So this is why I can stream you guys. This is why I'm very good at what I do when I stream. I can stream you guys on multiple platforms if you wanted me to. If you guys were able to get some type of live cams and things like that. But this is where I am.
Why did my camera just die?
Supposed to be a really good segue into letting Jack talk about.
Can you guys still hear me?
We can hear you. We just can't see you. So
my camera feed just died, huh?
And a bunch of you guys are heading over to the Silver Symposium, the Silver Party, and that would be like Economic Ninja, Joe Brown. I know he's going, and a bunch of other people. And I don't know, but tickets are still available. Where's that being hosted there?
It's in Spokane, Washington. I just got my camera back. I don't know what happened. I guess the algo just slapped me again because of your comment about digging behind the toilet. I don't know.
Damn, sorry.
It's in Spokane, Washington at the Northern Quest Resort and Casino.
Yeah.
2-day event. I'm going to be out there for a couple of days. I'll be making content. Ninja's going to be there. Joe Brown is going to be there. David Morgan, a lot of big names in the precious metal space, which Sage, I know you just absolutely love gold and silver. I'll be doing a part of an influencer roundtable. I'm going to do a presentation on the Chinese housing market and its effect on silver markets.
Yeah.
So I'm really looking forward to this. I'm very proud to be part of this. There is a link in the description down below. If you use that link, you'll get $10% off of your ticket price. And also, there should be a link down below, but I forgot to put it in. I'm sorry, Sage. To Sage News Live's channel on YouTube.
I'll drop. This is why I run the streams.
I did drop it in the live chats, so you can see it. My camera just died again. I don't get what's happening with my camera. I guess I didn't pay enough money for my camera. I don't know.
You can still hear and see your screen. So
okay. And by the way, I got another super chat here from my man Cheeseburger. Thank you very much, Matt. You're awesome, bud. And he says, can we petition Jack to wear a blue muumuu and a white cap on a live stream? Well, I actually, when my camera's dark, I just ran into a phone booth and changed. I'm wearing the blue muumuu and the white cap right now. You guys just can't see it due to some very unfortunate technical difficulties.
See, basically, they think I'm shadow banning you right now as punishment. How you like that?
Yeah, this is what happens when you bring Sage in. All right, my camera rebooted. Something's overheating. I don't know what's going on here. Thank you very much, Matt. I appreciate that very much. Guys, look, it's 4:16. Sage, that was an awesome segment. Thank you so much for putting that together for us. And man, that just screams recession right there.
Yes,
that information. So
I don't know what to tell Biden. I can show him that, but he might just color between the lines. Either way, I'm just saying that definitely says, and it's global. It's here. It's everywhere.
Yeah, define your way out of that one, buddy. Go ahead. I double dog dare you. And here we go. Here's Mr. Mike. He's saying, Klaus S. just switched your cam off. Eat the bugs, boys. Yes, I'm looking forward to some juicy mealworms and cricket flour after this. Nope, I don't need to eat the bugs. I have these wonderful little machines called chickens that turn bugs into human food, people food for us. So we'll be eating that instead. Thanks again, Mike. I appreciate the super chat. Mike Bender from Robin Models.
I'm safe. I eat leaves. I'm good.
Yeah. We vegan. Talking about the vegans is probably another thing that got me shadow banned.
That was probably the big one. I don't even do that. I don't even like vegans. So, and I am one.
All right, guys. We are going to call it there. Again, later on today, keep an eye out for that interview with the last bear standing about the China housing market. That is good stuff. I have that coming out, spread out over the next couple of days. He's a really good Twitter feed. I highly recommend that. Thank you to Sage. Thank you to Mish.
Nice cam.
Thank you to my Patreon supporters.
Thank you
to my camera, which keeps cutting out.
Thank you to the cam. Really quick too, I just want to jump in here. I've got a fantastic interview that I just did talking about, I won't get you banned, but talking about a way of life that comes out of China and Russia at one time and legitimately live through it. So definitely, if subscribe to my channel, hit the bell. You guys are going to not want to miss that interview.
I'm out. And that is Sage News Live. Again, I'm going to pin it in the comments and I'll go back and add it later on. But Sage just dropped out and my screen is black. You know what, Mish? You got anything you want to throw in there?
Well, I think I'm running a thing where if you can find Mish in the wild, I'll give you a Merc dime.
Ooh. And we already said where you are.
Yeah, good luck.
You hear that? That's the sound of a stampede into Lusk. Tell the Lusktonians to watch out because there's a bunch of Merc-hungry silver stackers are headed their way. Well, that is awesome. We will keep the hashtag Where's Mish going. And my camera is probably telling me right now that we need a break, so we're going to call it there, guys. Until next time, live small and dream big.
Cheers.